Greetings, Andre Gordon here. On today's episode, we're going to examine the concept of premium financing. But before we get started, please don't forget to smash that like button, hit that subscriber button, and the bell next to it in order to receive updated weekly content. The concept of premium financing for life insurance is a foreign concept to many people, but there are many individuals who are taking advantage of it for not only for their individual portfolios, but for businesses as well. So on today's episode, we're going to examine the concept of premium financing, its advantages and disadvantages, and what it means for you and your money. First, what is premium financing? Life insurance premium financing involves taking out a third-party loan to pay for policy premiums. As is the case with any other loan, the lender charges interest to the borrower, and in this case, the borrower is the insured, who pays that debt in regular installments until the debt is paid off. Or if the insured were to pass away, the balance that's remaining on that debt is typically paid off. This is typically a strategy that is being utilized by high net worth individuals who don't want to have to liquidate certain assets in order to pay for the high cost of life insurance premiums outright. This has been a strategy that has long been used by high net worth individuals who did not want to have to liquidate certain assets in order to pay for the high cost of life insurance premiums with large policies outright. The majority of Americans own some form of life insurance, either through personal ownership or through their employer. They see the value of having a policy that can financially take care of their loved ones in the event that they unexpectedly pass away. The same concept is true for premium financing. The difference is the amount of the policies are significantly larger, thus requiring a higher insurance premiums to pay for those policies. Many of these individuals do not want to deplete other assets, namely cash, in order to be able to pay for those premiums. So they leverage the lenders, in this case banking institutions, to be able to finance the cost of the premiums for those type of high dollar policies. High net worth individuals are typically looking for policies that start in the millions up to the tens of millions of dollars to address business, inheritance, and tax issues. For example, a $25 million 20-year term policy can run about $2,100 per month. Now, when you look at that same policy with the same dollar amount and you make that a whole life policy, the cost can be anywhere around $15,000 a month. Because these type of policies can cost anywhere from $100,000 or more per year. Premium financing makes sense for these type of individuals who can be able to borrow money close to the LIBOR rate while at the same time maintaining their investments that can yield a higher rate of return. Premium financing can also help the insured not trigger any capital gains tax issues from liquidating assets to pay for their insurance premiums. Although this strategy is appropriate for some individuals, it does come with some risks that the individuals need to be aware of before pursuing this strategy. Those risks would include interest rate risk. Interest rates are at historic lows right now, but that could spell trouble in the future. Right now, interest rates are at historic lows, and it's a great time to take advantage of a premium financing strategy. But when interest rates rise, and they will rise again, it could eat into the advantages of what a premium financing strategy was put in place to accomplish. Qualification risk. In order for the premium financing strategy to be effective, the insured must be able to qualify in getting financing from a banking institution. Given the current pandemic and the financial crisis that has resulted of this pandemic, many financial institutions are requiring extra qualification and additional resources to be able to have borrowers qualify for their lending programs. In many cases, financial institutions are requiring borrowers to re-qualify every time that the loan is renewed. In that renewal process, there is a reevaluation of the collateral that was used to get the financing in the first place. That can include both real estate, stocks, and other assets. Why is that important? Because if the value of certain investments, such as real estate, stock, or other investments, has fallen below the value that was originally used to get the financing in the first place, now that insured may have to put up additional collateral in order to be able to qualify for the loan terms to continue. Otherwise, if the insured can't provide additional collateral, the loan could come due, or it can be renewed at a significantly higher rate which eats into one of the advantages of doing premium financing in the first place. And since the loan is renewed after end of each term, the qualification risk never goes away until the insured passes away. And that qualification risk can be related to collateral value or any other underwriting standards that the lender may put forth as part of a credit. Since the loan is renewed after each term, the qualification risk never goes away until the insured passes away. That qualification risk can be tied to the collateral value related to stock, real estate, or other investments, and as the fluctuation of those investments change, you could be at risk for some requalification for that financing. Policy earnings risk. As with whole life or permanent policies, they have a cash value component. If the cash value underperforms, that could trigger a situation where the loan balance exceeds the value of the collateral used to get the loan in the first place. Now, the insured is required to put up additional collateral or the loan may go into default. Likewise, if the death benefit fails to grow, the coverage could be less than expected when the financing was originated to pay for the insurance policy in the first place. In the worst case scenario, the insured passes away with an outstanding balance on a depreciated loan policy based upon the decrease in value and death benefit. It will require the estate to have to step in and pay for additional costs that were not covered by the policy. Premium financing is widely accepted by many insurance companies, but there are only a certain amount of ideal clients where premium financing actually fits into their portfolio. The ideal client will have a net worth minimum of around $5 million. However, there is a sweet spot where this tool of premium financing is most utilized and most effective to use as a strategic tool for a financial portfolio, and that is around the $25 million net worth mark. This type of strategy would be available for real estate owners, privately held business owners, multifamily offices, corporate executives, private equity firms, and hedge fund managers. In addition to the advantage of the death benefit, the retained capital that can be deployed and utilized in other parts of the insured's investment portfolio is really one of the main advantages to utilizing premium financing. Some of the other advantages include reducing or eliminating the out-of-pocket expense for life insurance costs, taking advantage of the insurance company's credit rating, which can outperform borrowing costs, the opportunity for the money not spent on life insurance premiums to be deployed in other parts of the portfolio that can outperform borrowing costs, opportunity to purchase more life insurance based upon the premium financing than it would have been available for that individual to purchase if they had just paid for the policy out of pocket, and reducing or eliminating gift taxes. Interest rate risk can either be reduced or completely eliminated if the lender puts a cap on how high the interest can be, or if the insured is able to secure a fixed interest rate. Policy earnings risk can be reduced or eliminated in two ways. One is making sure that you choose an insurance company that has a long track record of delivering the type of policy earnings that you're looking for in terms of your policy and specifically with premium financing. Not every company is in the best position to offer a premium financing product at its best rate, so you need to do your due diligence with that. The second way is adding a special benefits rider to the policy that can also offset policy earnings risk. These type of measures typically do add cost to the policy. However, it can lower the risk of going with the premium financing strategy and provide peace of mind for those that are interested in implementing this strategy. Bottom line with premium financing is this: it is not a strategy that's appropriate or ideal for every situation. It is specifically designed for high net worth individuals who want to use capital in other places and can use the historic lows of interest rates as a leveraging tool to be able to purchase additional financing dollars to purchase large value life insurance policies. Several advantages and disadvantages to this strategy, including interest rate risk, qualification risk, and policy owner risk. There are many advantages and disadvantages which we laid out in our synopsis around premium financing. That would include interest rate risk, qualification risk, and policy earning risk. The upside of this strategy could be very beneficial for the right individual who wants to be able to leverage their financing. However, the upside potential of this premium financing strategy could provide huge benefits for the right individual in the right situation. As with anything, it's important for you to evaluate this premium financing strategy amongst all of your other investment opportunities and make sure that you understand the risk, understand how it's executed, and how it's going to impact you and your money. That is it. A synopsis of premium financing, its advantages and disadvantages, and how it works. Please don't forget to smash the like button and hit that subscriber button as well as the bell next to it in order to receive updated weekly content. Thank you for tuning in.